Welcome to the Deep Dive. This is where we take source material, could be articles, transcripts, you name it, and really pull out the key insights for you.
Yeah, giving you the shortcut, basically, so they don't get lost in all the detail.
Exactly. And today, we're digging into the recent earnings call transcript from GIII Apparel Group.
Our mission here is to figure out what this report really tells us about how they're doing right now, how they're handling some pretty significant challenges.
Yeah, definitely some headwinds.
And what their sort of strategic direction looks like going forward.
Okay, let's jump right in then. Headline numbers from their first quarter, this is for fiscal 2026. Non-GAAP EPS came in at $0.19 per diluted share.
Okay, and how does that compare?
Well, it's up from $0.12 last year, which is, solid growth. And interestingly, it actually beat the high end of their own guidance.
Oh, interesting. So an earnings beat, that's usually a good sign. What about the top line, the sales?
Net sales were $584 million. That was right in line with what they guided for. But it was a bit lower than the $610 million they did same time last year.
So earnings up. Sales slightly down year over year, but hitting their target. What was the story behind those numbers? What did they point to?
They were pretty clear on it. The key driver was the really strong performance of their owned brands.
Right, the ones they actually own, not just license.
Exactly. We're talking DKNY, Karl Lagerfeld, and Donna Karan. They saw double-digit growth in those core brands.
And that was enough to offset the lost sales from that Calvin Klein license they exited.
Pretty much, yeah. Largely offset the sales they lost from exiting the Calvin Klein jeans and sportswear business.
That's quite something, replacing license revenue with owned brand growth like that. So how did management kind of sum up the quarter?
They called the results solid and definitely highlighted the earnings outperformance. And they really emphasized how crucial the strength of those owned brands was.
Makes sense, helping them navigate, the current market.
So let's lean into that then. Driving the growth of those owned brands, that seems to be priority number one for them.
Absolutely. They see DKNY, Karl Lagerfeld, Donna Karan as the future, sustainable, higher margin profit drivers.
Yeah.
Plus, they generate licensing income on top of that.
Right. Accretive licensing income. And the transcript gave a lot of detail on how that's actually playing out, didn't it?
It really did. Let's maybe start with Donna Karan. They had a strong first year after the relaunch, and apparently that momentum just kept going right into Q1.
Okay.
Nearly 50% sales growth year over year. And importantly, the brand's hitting some of the highest average unit retails, AURs, and sell-throughs in their whole portfolio.
Wow, 50% growth. And high AURs and sell-throughs, that suggests strong demand, even at premium prices, right?
Exactly. It means people are buying it, and not just on sale. Specific categories. Dresses nearly doubled in sales. Suit separates also saw really significant growth.
And they're getting it into more stores?
Yeah, expanding distribution. It's not just online. They're getting into major department stores like Saks and Nordstrom. They expect to be in 50 Nordstrom doors by the fall.
50 doors, okay.
And overall, their domestic points of sale have jumped massively, from around 500 last spring to over 1,700 now. Plus, their own site, DonnaKaran.com, is growing strong too.
It wasn't just clothes either, was it?
No, accessories are doing well. Handbags are apparently commanding AURs up to $500.
$500 for a handbag, wow.
Yeah, pretty impressive. And they're smartly leveraging that brand equity through licensing fragrance, intimates, home, menswear. They specifically called out a new cashmere and vanilla fragrance launch, saying it's doing particularly well.
And they're putting marketing muscle behind it. That Kate Moss campaign generated, over $27 million in earned media value?
That's right, which is huge. Basically free exposure worth that much in ad spend. And they're seeing organic buzz too. Celebrities like Margot Robbie, Gwyneth Paltrow wearing the brand.
Okay, so Donna Karan's a success story post-relaunch. What about DKNY?
Also strong. Double-digit sales growth in North America, gaining market share across different categories. Jeans, interestingly, more than doubled sales.
Doubled, okay.
Yeah. Athleisure, handbags, swim, outerwear, all performing strongly too. And DKNY also has that growing licensing income stream, including men's categories. Their delicious fragrance even got nominated for an award.
And marketing there, I think they mentioned Lila Moss.
Yep, campaigns with Layla Moss, digital influencer programs. And they kept up that partnership with the New York Yankees, the billboard, the jersey giveaway event.
Right, and they mentioned international was doing okay too.
Yeah, particularly strong performance in Europe and solid sell-throughs in the Middle East for DKNY.
Okay, so that's two. Then Karl Lagerfeld.
The third owned brand.
Yeah.
And another quarter of double-digit growth in North America. Strength in sportswear, footwear, dresses, and suits. Suits grew over 20%. Menswear licensing is expanding there too, and internationally, they saw mid-single-digit sales increases.
They're also sort of refining the brand's positioning, aren't they? With those different lines?
Exactly.
Yeah.
I mentioned the Karl Studio line. That's for the more premium fashion-forward stuff. And then the Karl Lagerfeld jeans line grew 50%, and they think it's capturing a younger customer.
And retail expansion.
Opened a new store in Hamburg. And they ran a pop-up in Seoul in Asia that apparently did really well, exceeded sales projections, got a lot of media and influencer buzz.
So listening to all that, it's really clear that international expansion, especially Europe and Asia, is a huge focus for these owned brands. They see a lot of untapped potential there.
Definitely a key part of the growth story they're painting.
Okay, so own brands are firing on cylinders, central to the strategy. But they also spend a lot of time talking about the wider economy and, well, tariffs?
Oh, yeah, they did. Management acknowledged, the uncertain global picture, and then got specific about the potential hit from recent tariff developments.
What kind of hit are we talking?
They estimated the potential unmitigated impact for this fiscal year, FY26, could be around $135 million.
Wow, $135 million. That's a big number. Where's that coming from?
It mainly hits the second half of the year. And it factors in potential extra tariffs, like 30% on products from China, 10% on goods from other places. It's kind of the worst case scenario if they couldn't do anything about it.
Right, unmitigated. So the key question is, what are they doing to mitigate that, to lessen that blow? They outlined a few things, and sourcing diversification sounds like number one.
Exactly. And it's not new. They've been working on this for years. China used to be like almost 90% of their production.
90, really?
Yeah. By the end of this year, they expected to be less than 20%. Their supply chain now stretches across over 40 countries. That spread really helps buffer against risks tied to just one country, like these tariffs.
Okay, spreading the manufacturing helps.
Yeah.
What else? Vendor negotiations?
Yep. They're using their size, their scale, and those long-term relationships they have with suppliers to negotiate discounts. Basically saying, hey, we buy a lot, help us out here.
Right, leveraging their buying power. And then the tricky one, pricing, raising prices.
Yes. But they were careful to say selective retail price increases. They think they have pricing power, especially with those own brands, Donna Karan, Karl Lagerfeld, and the newer licenses too.
Why particularly those brands?
Because they don't have that long history of being heavily sold in off-price channels like TJ Maxx or Marshall's. So there's more flexibility.
Okay.
They also mentioned retailers seem to be accepting these adjustments. The focus is finding price points the end consumer will still tolerate. And it's easier to do this on, say, new spring lines, where you can build the costs in from the start.
And they expect competitors will probably raise prices too.
Yeah, they think so, which could actually maybe help GIII relative to the rest of the market if everyone's doing it.
Interesting point. Okay, so diversifying sourcing, negotiating, selective price hikes. What about inventory?
They ended Q1 with inventory down 5% year over year. They described it as lean.
Lean is good in uncertain times.
Right. They're being disciplined. Sounds like they're kind of chasing demand rather than sitting on piles of stock. But interestingly, they did mention they might actually accelerate some orders, pull receipts into Q2.
Why would they do that if things are uncertain?
To get ahead of potential future tariff changes or just more uncertainty, get the goods landed before costs potentially jump. They framed it as a strategic move.
Makes sense. Get it in before the gate closes, potentially. And they also talked about just general cost savings, operational efficiencies.
Yes, especially as they're transitioning away from those big PVH licenses. That means streamlining their warehouse network. They're exiting 4 warehouses, reducing staff by over 150 people.
Okay.
Also integrating international warehousing, reducing inbound freight costs through consolidation. Standard efficiency stuff, but important.
And investing in systems, digital tools, optimizing real estate, renegotiating their office lease even.
Yeah, they mentioned getting kick-out options on a third of their corporate office space and looking at their global store footprint. And tied into this, that North American retail segment turnaround seems to be working. They expect it to break even this year.
Which eliminates about $14 million in operating losses, right?
Exactly. So all these things are levers they're pulling to try and offset that big potential tariff number and any other cost pressures.
And one very specific decision linked to all this uncertainty was about Sonia Rykiel.
Right, the relaunch. They decided to postpone it.
Canceled the initial production run, I think?
Exactly. They pointed to the general uncertainty, tariffs included, but also some production challenges with the small initial quantities. They basically figured it was less risky, less costly to hit pause now rather than push ahead and maybe lose money in this environment.
Plan is to revisit it when things calm down.
That's what they said. And importantly, they noted that canceling this didn't make them lower their full-year sales guidance.
Oh, interesting. So strength elsewhere is making up for it.
Seems so. Which brings us to that second strategic pillar they discussed, expanding their strategic licenses.
Right, because alongside building their own brands, they're still managing, what, over 30 different licensed brands?
Yeah, they see it as a capital-light way to grow using their existing operational platform, sourcing, distribution, etc. They really highlighted the value they bring to retailers here.
Like what?
Consistent product quality, delivering on time, having field merchandisers in stores helping manage the product. They won Macy's Partner of the Year award again and pointed to that as proof of strong retail relationships.
And they have some newer licenses that are starting to gain traction.
Yes, brands like Nordica Jeans, Holston, Champion Outerwear are apparently doing well. They specifically mentioned Nordica Jeans as basically offsetting the sales they lost from exiting the Tommy Jeans business.
Even with some initial limitations on where they could sell Nordica.
Apparently so. Shows the strength of the brand or their execution, maybe both.
And looking ahead to the fall, a couple of big launches coming up, Converse and BCBG apparel.
That Converse launch sounds particularly interesting, gets them into totally new channels.
Right.
Sports specialty stores, big box retailers like Target maybe, sporting goods stores. It also gives them a foothold in Western Europe in a new way.
Yeah.
And potentially lets them service Converse's own network of over 1,000 stores globally.
That's reaching a whole new customer base.
For sure.
Okay, and speaking of licenses ending, they confirmed the Calvin Klein jeans and sportswear exited this fiscal year, FY26. That was about $175 million in sales last year.
Right, which, as we said, is largely being offset by growth in brands like DKNY and Karl Lagerfeld.
And they're already looking ahead to FY27 when more PVH licenses expire. Calvin Klein, outerwear, Tommy Hilfiger.
Yeah, outerwear, sportswear, athleisure for both.
Yeah.
But they're trying to frame this not just as losing business, but as an opportunity for G3.
How so?
Their thinking is, as PVH takes that business back in-house or finds new partners, there'll be disruption. And G3 believes it can potentially grab some of that market share with its own brands, while also focusing on unlocking the global potential of DKNY, Donna Karan, and Karl Lagerfeld.
Okay, makes sense. Strategic pivot.
So, own brands, navigating tariffs and license changes. The third pillar was enhancing omni-channel, improving retail, strengthening digital.
Yeah, on the retail side, that turnaround strategy seems to be on track. They cut operating losses by more than half last year in their North American stores.
And expect to break even this year, right? Wiping out about $14 million in losses.
Exactly. And digital's growing too. High single-digit sales growth across retailer websites and the pure play online guys like Amazon.
And they're investing in their own brand websites.
Yeah, expanding the lifestyle offerings there, trying to drive more direct engagement and sales, gain market share online.
Okay, let's shift to the guidance and the overall financial health picture. For the full fiscal year 2026, they did reaffirm their net sales guidance, right? Sticking to approximately $3.14 billion for the top line.
So despite everything the license exits, the macro uncertainty, they still feel confident they can hit that sales number.
Seems so. However, and this is important, they withdrew their guidance for the bottom line stuff, net income, non-GAAP net income, and adjusted EBITDA for the full year.
Pulled the profit forecast because of the tariff and economic uncertainty.
Exactly. That potential $135 million tariff hit makes forecasting profit pretty tough right now.
Understandable. What about the current quarter, Q2? Did they give guidance there?
They did. For Q2 FY26, they guided net sales to about $570 million. That's down from $645 million last year.
And why the drop?
A few reasons they gave. Timing shifts, some programs moved into the second half. Some supply chain disruption from tariffs already hitting Q2, about $30 million worth they estimated. The Hudson Bay Canada bankruptcy liquidation had an impact, and that Sonia Reichel cancellation we talked about.
Got it. Mostly timing and some initial tariff bumps. What about Q2 margins and earnings per share?
They expect Q2 gross margins to be basically in line with last year. They think only a small tariff impact will actually hit in Q2 itself.
Okay.
But the non-GAAP EPS guidance for Q2 is quite wide, $0 to $2.12. Compare that to $0.52 last year. That range really reflects the uncertainty.
Yeah, a big drop expected there. Looking further out, second half of the year, what's the sales pattern look like?
They expect things to pick up.
Oh,
A low single-digit sales increase for Q3, and then a mid-single-digit increase for Q4.
driven by...
Strength of the own brands, those new license launches like Converse and BCBG hitting shelves, and also those programs that shifted out of Q2 into the second half.
Okay, so despite the headwinds and pulling the profit guidance, their actual financial position sounds pretty solid.
Very solid, actually. They ended Q1 with about $740 million in liquidity. That's cash plus what they can borrow. And their net cash position, cash minus debt, was around $239 million.
That's way up from last year, isn't it?
Yeah, significantly up from $82 million a year ago. A much stronger balance sheet.
And that gives them options.
Absolutely. Flexibility. They mentioned they bought back $20 million worth of their own shares in Q1, and they really emphasized that this financial strength lets them keep investing in the business and leaves the door open for future opportunities, maybe more licenses, maybe even acquisitions down the road.
Did the Q&A session after the main presentation add any more color? Did they elaborate on anything?
Yeah, a few points got reinforced. On pricing, they doubled down on it being selective, focused on what the consumer will accept, and they reiterated why they think they have more power with the owned and newer brands that lack of off-price history.
The Sonia Reichel decision came up again?
It did. They basically just reaffirmed the logic. It was about avoiding potential losses on a small launch during a really uncertain time, especially with tariffs and maybe some production headaches for small runs. A prudent move, they felt.
What about current demand and how they're managing the supply chain now?
They said overall demand feels maybe a bit slower out there in the market generally, but they sounded optimistic about the second half, pinning hopes on the newness they're bringing. Inventory buying is cautious, prudent, matching it to what they expect to sell.
Right.
And they're actively managing those supply chain shifts, diversification, tariffs. And again, viewing that potential acceleration of receipts in Q2 as a smart strategic move to de-risk from future tariff changes.
And the promotional environment, are they having to discount heavily?
They said they're not feeling significant pressure themselves. They think their product quality and service levels help them hold the line on price. Interestingly, they also noted that those PVH brands they're exiting are actually selling really well in the market, high demand, even though GIII has less inventory of them now.
Okay, so let's try and wrap this up. Connecting it back to you, the listener. What does taking a deep dive into a call like this from GIII Apparel really teach us?
Well, I think it shows how a company really leverages its core strengths. You know, things like building up brand equity, having real operational expertise, especially in sourcing and supply chain, which is critical now, and maintaining that strong balance sheet. That's how they navigate these big external challenges like tariffs and a shaky economy.
Yeah, and it really highlights that dual strategy they're running. On one hand, really nurturing those high-margin owned brands, getting them to grow fast. And on the other hand, using their platform, their scale, their retail relationships to manage and launch strategic licenses.
And maybe the biggest takeaway for me is just the importance of being adaptable. You know, being willing to shift your sourcing significantly like they have, being willing to postpone a brand launch if the timing isn't right, actively managing inventory, cutting costs where you can. These are all crucial moves when things are volatile.
Absolutely. So that was our deep dive into the recent GIII Apparel Group earnings call. We covered their Q1 performance, that big strategic shift towards own brands, their battle plan for potential tariffs.
Yeah, the evolution of their license portfolio, what's going out, what's coming in, and how they're trying to strengthen their connection with customers, both online and in stores.
And hopefully digging into these details helps you look beyond just the headline numbers and get a better feel for the operational realities, the strategic choices a company like GIII is making to set itself up for the future.
Now, as always, this discussion is purely for informational purposes. It is definitely not financial advice.
Something to keep firmly in mind. Okay, here's a final thought for you to chew on, building on what we've discussed. Given GIII's really clear strategic pivot towards these higher margin owned brands, DKNY, Karl Lagerfeld, Donna Karan, and knowing that those big PVH licenses are phasing out over the next year or so, how might their fundamental profitability profile actually change once those licenses are fully gone, even if the tariff situation stays tricky?
And maybe, what does that potential shift suggest about the long-term value they believe they're building in that owned brand portfolio? Something to think about.
Definitely something to consider. Thanks for joining us for this deep dive.